Welcoming all the viewers through this educational channel, that is Accounting Equation Academy, presenting today's second class on accounting ratios. And in my preceding class I explained you about the accounting ratio, what is accounting ratio, what is ratio analysis, and what are the different classification of accounting ratios. So these are discussed in my preceding class, and among them the important ratio classification is liquidity ratio, and these ratios are classified from different point of view. Under the liquidity ratio we normally calculated two ratios, that is current ratio and liquid ratio. Current ratio I had explained you in my preceding video class, and today's I am going to explain you liquid ratio. So under liquidity ratio, that is liquid ratio, and which is also called quick ratio or acid test ratio. This is on your screen, and how this is calculated, it establishes the relationship between quick assets and current liabilities. So current liabilities, the meaning is same as we have calculated in current ratio calculations. Quick assets can be converted into cash without any loss or delay. Like a bill receivable amount, it is receivable amount. So if we realize it, so without a delay or without any loss amount, so we will realize this bills receivable amount. And here again given that all current assets excepting stock or inventory and prepaid expenses are considered to be quick assets. It means that when we calculate the quick assets, that is stock and inventory and prepaid expenses are not taken into account, and rest of the current assets are liquid assets. So here we can say that all liquid assets are current assets, but all current assets are not liquid assets, because the liquid assets are current assets, and here are some current assets are only current asset, they are not liquid assets, but some current assets they are also considered liquid assets too. And here this is liquid assets items given. Normally these assets are considered liquid assets, like here cash in hand plus cash at bank, bill receivable plus sundry debtors. So bill receivable plus sundry debtors together we say also trade receivable, and marketable security, short term investment, accrued income, these are considered liquid assets. And current liabilities, so it has the same meaning as used in current ratio. So that is current liabilities in the current ratio and current liabilities in the liquid ratio, there is no difference. So same current liabilities meaning, okay, for the purpose of calculation of liquid ratio as well as current ratio. Okay, the main objective of calculating liquid ratio is to ascertain the short term liquidity position of the business. Short term liquidity position of the business, as the liquidity implies the ability to convert current assets into cash. So those current assets which can be converted into cash are considered liquid assets. Alright, so those current assets which are converted into cash without any loss or delay are liquid assets. So and in the accounting we presume that a stock or inventory and prepaid expenses, these two items cannot be converted into cash without any loss or delay. These two assets cannot be converted into cash immediately. So it takes time. A stock, the goods lying unsold, so when we convert it into cash, it takes time, as well as there may be loss on realization of this stock. And in the same manner, prepaid expenses which is paid in advance, so it cannot be converted into cash. With this assumption, so these two items normally we exclude from liquid assets, and the rest liquid assets are current assets as well as liquid assets. So that therefore I am telling you all that all liquid assets are current assets, but all current assets are not liquid assets, because inventory and prepaid expenses, they are current assets, but they are not liquid assets. Well, students, so here on the basis of above explanations, I have taken one simple problem for calculating liquid ratio. From the following information, calculate liquid ratio, and here cash and cash equivalent, or we can say cash in hand plus cash at bank together, this is the 30,000. So it is liquid assets as well as current assets. And now trade receivable, it is a current assets as well as liquid assets. Marketable security, it is current assets as well as liquid assets. Similarly, short term investment, it is current assets as well as liquid assets. Okay, so and next here, a stock, it is only current assets, not liquid assets. Prepaid expenses, it is only current assets, not liquid assets. And trade payables, current liabilities, short term borrowings, current liabilities, salary outstanding, current liabilities, provision for tax, current liabilities. So based on these informations, we have to calculate a liquid ratio. So here the liquid ratio formula, liquid assets by current liabilities. Okay, so you remember that liquid assets divided by current liabilities, and the liquid assets here, cash and cash equivalent given in the questions, plus trade receivable plus marketable securities plus short term investment. So these amounts, these items are liquid assets as well as current assets. So substituting the values of these items, so here we got 1 lakh liquid assets, and current liabilities are given here in the questions: trade payable, short term borrowing, salary outstanding, provision for tax. Substitute the values from the given questions. Here this is the 30,000 plus 20 plus 20 plus 30,000, so this is aggregate total value is 1 lakh. And now therefore liquid ratio. Okay, so therefore liquid ratio, so the liquid assets to we got total 1 lakh, and current liabilities we also got total 1 lakh, and 1 lakh divided by 1 lakh, so it is 1:1. So this is the ideal ratio, this is a satisfactory ratio. A business always try to maintain their liquid ratio 1:1. So 1:1 is the satisfactory ratio. Okay, sometimes you get one question that what is the ideal liquid ratio, then you have to write 1:1. And similarly, what is the ideal current ratio, then you have to write 2:1. Okay, so this is the satisfactory ratio for current ratio, and this is the satisfactory ratio for liquid ratio. Alright, so now I am giving you one simple task, that from these questions liquid ratio is to calculated, now you have to calculate current ratio. Okay, calculate current ratio from the above questions problem, and this is the problems I am giving you for your practice. So all of you practice this problem, calculate the current ratio, and in comment sections you write down what is your answers you are getting. I will reply you. Okay, do not hesitate, all of you try, practice it, then you learn the thing. Unless you practice you won't learn. All right. Okay, what is current assets? Meaning is given here. What is current assets? So then current assets are cash, cash equivalent, and other assets which are expected to be realized in cash or sold or consumed within 1 year. This is the meaning of current assets. And here it is given assets. Cash and cash equivalent mean cash in hand, cash at bank, check, draft, short-term investment which can be easily converted into cash, and other assets which are expected to be realized in cash. That means getting cash against this asset, or sold, that is the goods sold, a stock sold, or consume, that is the raw materials used for manufacturing of goods, and which is consumed within 1 year. So this type of assets are current assets, and here meaning you remember this one. Similarly, current liabilities, these are obligations of the firm which are repayable within a relatively short period of time, usually 1 year. Okay, so then amount which is payable within 12 months from the date of balance sheet, this is called current liabilities. Clear? Amount which is payable within 12 months from the date of the balance sheet is your current liabilities. So 12 months period, 12 months or less than 12 months. If it is payable after 12 months, so then it will be called non-current liabilities. Now here the term one more, cash and cash equivalent. Examples are given. Balance with bank, that is cash at bank. Okay, and this is come under cash and cash equivalent. Similarly, cash in hand, it comes under cash and cash equivalent. Checks, draft in hand, short-term investment normally qualifies as a cash equivalent only when it has short maturity of say 3 months or less from the date of acquisition. So any investment is purchased and this its maturity period, that is it can be converted into cash. Okay, qualify as a cash or converted into cash when it has a short maturity of say 3 months or less from the date of acquisition, then it will be also considered cash and cash equivalents. I explained you, so all of you watch it and like and subscribe the channel.